In the high-stakes world of technology, where innovation and competition move at lightning speed, every decision can have far-reaching consequences. The global semiconductor industry, often described as the backbone of modern electronics, is especially sensitive to policy changes and international relations. Even a minor policy shift can send shockwaves through global markets, causing investors and companies to scramble as they try to anticipate the next big move. The stakes are enormous, with billions of dollars, and the future of entire industries hanging in the balance. On December 10, 2025, the US government made headlines by announcing it would ease some export restrictions on Nvidia, the world's leading designer of advanced AI chips. This policy change would allow Nvidia to resume limited sales of its cutting-edge chips to select Chinese customers, a move that surprised many industry watchers and market analysts. But instead of boosting the fortunes of Chinese chipmakers, the news had the opposite effect. Their stocks tumbled sharply, wiping out billions in market value within hours. Investors were caught off guard, and the mood quickly shifted from optimism to anxiety. The return of a powerful American competitor, even if only in a restricted capacity, was immediately seen as a major threat to China's domestic chip sector. For Chinese companies, the prospect of competing once again with Nvidia's superior technology raised serious concerns about their ability to maintain market share and continue their rapid growth. For years, strict U.S. export controls had acted as a protective shield for Chinese chipmakers, fueling their expansion by forcing local tech giants to buy homegrown products. This environment allowed domestic firms to innovate, scale up production, and attract significant investment, all while enjoying a captive market. Now, with Nvidia's highly sought-after chips back on the table, investors fear that Chinese firms will lose their hard-won advantages. The competition is expected to intensify, making the path toward self-sufficiency even steeper and more uncertain for China's semiconductor industry. The market's reaction is a stark reminder that China's journey to tech independence is fraught with unexpected obstacles. Despite years of progress, the allure of superior foreign products remains strong, and the global chip saga is far from over. The next chapter promises even more twists and turns as nations and companies vie for technological supremacy. The recent U.S. policy shift regarding technology exports to China is nuanced and complex, rather than a straightforward reversal of previous restrictions. Instead of opening the floodgates, the U.S. is taking a cautious, measured approach, signaling a willingness to engage but with clear boundaries. Under the new rules, Nvidia and other American chipmakers can now apply for licenses to export certain advanced, but not the most cutting-edge AI chips to China. These licenses are subject to strict vetting, with the U.S. government determined to prevent any technology from reaching Chinese military-linked entities or being used in sensitive applications. Every transaction is closely scrutinized, with multiple layers of review and compliance checks. This makes the process slow, unpredictable, and often frustrating for companies hoping for quick approvals. For Nvidia, this policy adjustment represents a partial reopening of a highly lucrative market. However, the company must now navigate a maze of compliance requirements, legal uncertainties, and shifting political winds, all of which add significant operational challenges. On the other side, Chinese tech giants like Alibaba and Tencent are eager to access these advanced chips to power their AI ambitions. Yet, the approval process remains unpredictable and is deeply influenced by the broader political climate between the two countries. For Chinese firms, the new rules offer both hope and uncertainty. While there's a chance to acquire more advanced technology, the unpredictability of approvals makes long-term planning and investment decisions much more complicated. Ultimately, the U.S. is trying to strike a delicate balance, allowing its companies to benefit from the vast Chinese market, while still protecting national security interests and keeping China from closing the technology gap too quickly. This recalibration of export policy introduces new challenges and uncertainties for everyone involved in the global chip supply chain, from manufacturers and exporters to end users and governments worldwide.
U.S. export controls had shielded China's chip industry, forcing tech firms to buy local and fueling rapid growth. With Nvidia's partial return, that protection is eroding. Even though these aren't Nvidia's most advanced chips, they still outperform domestic alternatives by a wide margin. Chinese companies, driven by performance, will be tempted to switch back to Nvidia. Investors fear demand for homegrown chips will drop, stalling the momentum of China's chip makers. The sell-off in Chinese chip stocks reflects a new reality. The road to profitability and technological parity just got longer. Now, domestic firms must compete head-to-head with the global leader, a daunting prospect. The protective wall is crumbling, and the challenge has never been greater. China's ambitious drive for chip self-sufficiency is anchored by a handful of key players, with SMIC standing at the forefront as the nation's leading chip foundry. SMIC is not just a symbol of China's technological aspirations, but also a critical pillar in the country's efforts to reduce reliance on foreign technology. The company has invested heavily in research, development, and manufacturing capacity, aiming to close the gap with global giants. However, SMIC's shares took another hit after the recent Nvidia news, highlighting investor anxiety and reflecting widespread fears of shrinking demand for domestically produced chips. The market's reaction underscores just how sensitive China's chip sector is to international developments and policy changes. Huahong Semiconductor, which focuses on mature chip technologies used in everything from cars to industrial equipment, also saw its stock price tumble. The company's fortunes are closely tied to the broader health of China's tech industry, making it vulnerable to global headwinds. Cambricon Technologies, a leading designer of AI accelerators, is now facing even fiercer competition from global heavyweights like Nvidia. With the AI chip market heating up, Cambricon is under mounting pressure to innovate and maintain its edge, all while navigating a challenging regulatory environment. Even equipment suppliers such as Nora Technology Group are feeling the strain. As foundries like SMIC and Huahong reconsider their expansion plans, companies that provide the tools and machinery for chip making are bracing for a slowdown in orders and investment. The entire semiconductor supply chain is deeply interconnected. One policy change or market shock can send ripples through manufacturers, chip designers, and equipment makers alike. Each link in the chain depends on the others, making the ecosystem both dynamic and fragile. The sharp negative reaction in the markets reveals just how exposed and vulnerable China's chip ecosystem remains to global shifts, whether they come from new regulations, export controls, or changing demand. Every segment of the industry, from massive foundries to nimble design firms, is now under renewed pressure to adapt, innovate, and survive in an increasingly uncertain environment. The stakes for China's chip champions have never been higher, as the nation's technological future and its place in the global economy hangs in the balance. China's tech giants now face a tough choice: buy superior Nvidia chips or support domestic suppliers.
From a business perspective, Nvidia's chips offer unmatched performance and efficiency.
But the government is pushing hard for self-reliance, urging companies to buy local and help close the technology gap.
Choosing Nvidia isn't just a business decision, it's a political one, with national strategy at stake.
Executives risk scrutiny from Beijing if they favor foreign chips, but relying on US supply chains is risky and unpredictable.
Opting for domestic chips means accepting lower performance, which could hurt competitiveness.
Most companies will likely hedge, buying Nvidia chips when possible, while continuing to invest in local alternatives. This balancing act reflects the deep uncertainty in China's tech landscape. As Nvidia's return rattled markets, Beijing responded with a strategic move.
For the first time, China added domestic AI chips to its official government procurement lists, directing state agencies and enterprises to buy local.
This policy creates a guaranteed market for Chinese chip makers, offsetting potential losses from private tech giants turning to Nvidia.
The inclusion of companies like Huawei signals strong state support and provides a vital revenue stream.
The Buy China mandate splits the market. Private firms weigh performance, but the state sector must buy local. This ensures the survival and growth of China's chip industry, even if it struggles in the open market. The state's intervention is a powerful tool to keep the domestic industry afloat. The U.S. policy shift and falling Chinese chip stocks have real-world consequences.
Investors who bet on China's self-sufficiency are now rethinking their strategies as market optimism fades.
The drop in share prices means millions in losses and a sudden shift in sentiment.
For workers in China's chip industry, the news brings uncertainty. Growth may slow and hiring could freeze.
Private sector demand is at risk, even as government contracts provide a safety net.
In the US, Nvidia's partial return to China is a financial win, but sparks debate over national security.
The chip rivalry affects everything from national pride in China to the price of electronics worldwide. The global supply chain remains fragile, and policy decisions in Washington and Beijing ripple out to consumers everywhere. The chip saga highlights the diverging strategies of the US and China.
The US wants to slow China's military tech progress while keeping its own companies profitable.
The new policy lets China access older tech, keeping it dependent and behind the curve.
It's a strategy of managed containment, profit-driven, but rooted in national security. China, meanwhile, is all in on tech sovereignty, using state power to build a parallel ecosystem.
The Buy China mandate is about survival, not short-term profit.
Two distinct semiconductor industries are emerging: a global market led by the US and a China-centric state-driven market. The long-term trend is decoupling, as China bets on self-reliance to break free from foreign tech dependence. The global chip industry remains a battleground for geopolitical rivalry.
The US will keep fine-tuning export controls, creating ongoing uncertainty for businesses.
China's chipmakers must innovate rapidly, but true success means matching foreign products on merit.
The return of Nvidia is a reminder that the technology race never stands still.
The world may see fragmented tech blocks, with companies forced to adapt to diverging standards.
The era of seamless globalization is ending. The chip race is a marathon, not a sprint. The future of global tech leadership will be decided by which strategy, managed containment or state-driven self-reliance, ultimately prevails.